All right, welcome back everyone to yet another video. And in today's video here, we'll be covering one of Amit's favorite stocks. And it is actually quite an interesting one. And it is, of course, Grab Holdings. So I just recently published a full PDF report, an equity research report on the company. So you can grab it for free by going to research.typeofcapital.com. Scroll down to Grab here. And then you can just download the PDF here. And it is a full-size report. So we'll be going through parts of this in today's video. If you want to dig deeper and really get into the weeds here, just download the report and read it at your own leisure. But what we're going to be doing today is go through some specific segments, because I believe that this company is actually quite a lot more interesting than people give it credit to. You know, on a surface level, people might think, well, it's just Uber in Southeast Asia, who cares? But the story is actually quite more interesting than that. And I just realized it after I, finished my research on the company. So I want to take you through some of the, interesting parts here. So first things first, fair intrinsic value. And that is accounting for the geography risk. There is a company that is operating in Southeast Asia. $7.25 per share, which is roughly a double from where it's trading today. And, Grab is not the only company that has been, seeing volatility as of late. It's not the only company that has sold down, but I believe that this is still quite attractive. And as I mentioned, they operate in Southeast Asia, and that market has been, a bloodbath. And why is that? Well, because the regions in Southeast Asia has some of the fastest average GDP growths in the world. Only hyper-growth countries like India outpace them. But in aggregate, Southeast Asia is very underdeveloped, and it's just now starting to actually mature. And the growth expected from the region is very, very fast. So that naturally makes it very attractive for various businesses to operate in. And if you go back a few years, many people, believe that Grab wouldn't even survive. And, every company that operates in that region, it is a fierce competition. Fierce competition means, price pressures, when everyone has, all the different apps across each product segments, and then they just open to see, okay, which service is the cheapest right now, and they go with that. There was no loyalty, no user loyalty. There were no ecosystem lock-ins. That has changed. Actually, Grab now sits at a 71% market share in the ride-hailing market. 71%, across the major Southeast Asian countries, and 65% in the deliveries market. So Grab has really emerged as the victor and majority market share holder, across the region. And only now will Grab start to leverage that into real cash generation. And I think a lot of people are missing that part of the story here, because it's easy to think that, well, a lot of competition, everyone's losing money. Well, that was true, and Grab was in those trenches, but they are now emerging out of that and will transition. They recorded their first year of operational profitability in 2025, and we'll get into some of the opportunities for the company as we move along here. So I won't cover everything in detail. You should go and read the report for that. But in short, for those that are not familiar with Grab, it's a super app. And, that term is, people love to throw around the term super app, when in reality, there's only one true super app. And by that, I mean where you do everything from a single app in your day-to-day life. And that is WeChat in China, that has something of an install base of 95% of China's population has that app installed. I mean, people run businesses from it, they pay through it, they, book travel, they order clothes, they do everything from that app. And what's interesting now is what I just mentioned, of what Chinese users do through WeChat. Grab is now starting to offer similar things as well, really earning the name of super app. So they have three main business segments. One, of course, and where it all began. It began in the mobility one, sorry. Basically a ride-hailing service, connecting passengers and drivers, in simple terms. The deliveries, which is a natural extension of that, where you have drivers deliver food, groceries, parcels, stuff like that. And then you have the third leg, which is financial services, lending, insurances, digital banks, and now also in investing. And you might think that, well, they already have a majority market share. How much growth is there to be had? Well, we'll get into that. And as I mentioned, the market they operate in is one of the fastest growing ones in the world. So there's still, a lot of growth to be expected. So if we look here at the historical revenue chart, we can see that, 2019 was negative revenue. How come? Well, the incentives they paid out to users and drivers in their, ecosystem outweighed how much revenue they were generating, from the gross merchandise value, GMV. You'll see that term. That outpaced the revenue. So that's why this year is actually negative revenue. However, since then, they've started to actually accelerate their growth and accelerate it by a lot. And management is guiding, 20% for the next 3 years. 2025 was basically, 20.5%. So they are guiding for an extension of that for 3 years. I personally think that Grab will far outgrow that and for a lot longer than just 3 years. And we'll get into why. And just briefly here on the stock performance against the SPY. So you have SPY in the black line and then you have Grab in the golden line. You can see that it is quite a volatile stock, And as of late, there's a lot of volatility in the markets, as you might have felt by looking at your portfolio. But Grab really has been sort of range bound, for quite some time. And it frustrates a lot of, of your investors when the stock doesn't really move, even though the business is performing well. But yeah, I mean, they are operating in Southeast Asia. People in America might not be too familiar with the business, but everyone that I've talked to that has used this app is very, very happy with it. And they operate something what I call a natural monopoly. Even though they don't have a monopoly, in essence, a natural monopoly means that the users want to use your services. They want to use your products. An unnatural monopoly would be something like inorganic monopoly is a better term. It's something like a Microsoft. No one really wants to use Copilot. They kind of shove it down your throat. And the same goes for a lot of the, suite of products that Microsoft offers. They kind of force it onto you. And even though there are better alternatives available, you're kind of locked in with Microsoft, in your corporate enterprises and stuff like that. So that's a bit of an inorganic monopoly, whereas Grab is more towards the characteristics of, a natural monopoly where, people want to use their services because they're genuinely better than everyone else's. And we'll get into that right now, actually. So what I call the business flywheel. And they have a ton of products. We're not going to go through everything today. But as I mentioned, the main segments are, mobility, which is the ride-hailing one. Think Uber, deliveries, financial services. And then they have a fourth leg, which is basically enterprise solutions for businesses, things like ads, an ad platform and stuff like that. Now, what makes Grab so attractive today is the vast ecosystem that I managed to build. They started as a simple ride-hailing service, where there was a need to solve some, regional issues, with the taxis. It was unsafe, unreliable. The coverage wasn't very good, So when they started the company in 2012, they only had one product. That has now developed, to have many, many more products inside their ecosystem. And it's all based on, what do our users want? What do our drivers need? What do the merchants need? And what you get is a, self-reinforcing flywheel where, better services, attract more users. And when you have more users, naturally, all the merchants and drivers want to be on the platform with the most users. And then that increases, coverage and utilization. And that in turn attracts more users. So you have this, self-reinforcing flywheel effect going on. And, the efficiencies that come with scale are really, really big. And we'll get into that just shortly here. So here I go into, some of the origins of the company. As I mentioned, they launched branded My Taxi, in 2012 in Malaysia to address, unsafe, unreliable, and hard to hail taxis. And then, they expanded from there. But the major development for the company actually came in 2018 when they acquired Uber's entire Southeast Asian segment. Uber was burning hundreds of millions in the region while they were, starting to actually generate real cash and real revenues, in the West. So they just cut their losses, acquired a stake in Grab, and gave up their whole, regional operations to Grab. And for Grab, that meant, all of Uber's drivers, their users, and operations, across the whole region. So that really accelerated, Grab overnight, more or less. And that's when they started to have, full market dominance, when they outcompeted one of their biggest competitors in the region. Now, there still exists some competition. We'll get into the risks, but as I mentioned, they have a 71% market share in the region. And ride-hailing as a segment, in Southeast Asia, it's expected to compound at something like 15% over the coming years. And the Grab, they have roughly 71%, it dipped down to 69 and then up to 71. So it will, vary by a percent or two, year to year. But what's important to keep in mind here is that they are the dominant market shareholder in this whole segment that is expected to compound at 15%. Now, you might think, well, only 15%, but they already have a 71% market share. So how much growth is there really for Grab to be had? Well, as I mentioned, many of these regions are very underdeveloped and underpenetrated. And you'll see this across, each business segment. While Grab, has a 71% market share, in, the second largest, market, which is Vietnam, they only have 9%, penetration rate in monthly transacting users, which is basically, how many monthly active users do they have? It's only 9% in Vietnam. And Vietnam as a market, a ride-hailing market, is expected to compound at 20% for the next 5 years. So, only 9% penetration rate in a market that is growing 20%. There's a lot of room to grow here, Of course, the highest penetration rate is where their business is headquartered in Singapore. Singapore, a lot more mature than these other Southeast Asian countries. The GDP is a lot higher. It's a lot more developed as a nation. Very, very rich country. It's only expected to compound at 8%. But then you have something like Vietnam, 20%. Indonesia, expected to compound at 13%. I personally believe that it will be higher, but I'm citing, economy C here primarily. But yeah, Indonesia, very, very, about 4% penetration rate in monthly transacting users. And Indonesia is the country in Southeast Asia with the biggest population. So there's still a lot of room for growth here over the next 5 years. And another concern that people might have with the ride-hailing industry as a whole is that, well, Uber faces a lot of concerns from companies like Tesla. What will happen with Uber when robo-taxi fleets launch, or when the Google equivalent autonomous vehicles expand more? What will happen to Uber? Well, Grab actually doesn't really face the same issue for multiple reasons. One, they are basically partnering with everyone in the region that is a key player. So they don't really care like which company has the best, autonomous vehicle. They don't care which company has the best EV. They partner with all of them. And unlike Uber, they actually provide vehicles for their drivers. By buying and leasing their whole fleets, they can lower costs. They can lower the barrier to entry for drivers, making it more widely available. They lower maintenance costs, that comes with scale. And ultimately, it leads to a lower price per fare for the users, which means that more users want to use it. That in turn increases the scale. So it's all, self-reinforcing, and you'll see that through all of the segments here. And what really, solidifies that is that they just reported Q4 of 2025. Since 2021, driver earnings per operating hours increased by basically 30%. During the same time, the average trip fare lowered by 16%. So users are paying less and drivers are making 30% more. But for Grab, they only increased incentives by 1%, measured against the GMV. So, the whole ecosystem really benefits from scale and everyone wins. It's a win-win-win situation where Grab wins, the users win, and the drivers win. And that's really the magic formula here. And you'll see that more as we go along here. So next, the natural extension to having a ride-hailing business is, of course, the delivery. So it could be, it started as, food delivery market, which then, also includes, parcel network that they have and stuff like that. So it's really a natural extension, because when you have a driver that, okay, maybe no one wants to go from point A to point B right now in my region. However, someone wants, their food delivered, so they can keep working and earning more and have less downtime, while, the users have a, wider coverage for, their needs. And if we look, this is not a one-to-one exactly, but if we look at the food delivery market here, it is also expected to, grow quite fast. And Grab has something like, 65% market share of that. And it is, going up very, very fast. And the food delivery market in itself, it's not expected to grow as fast. The transport market is expected to compound at 15%. The food delivery market only expected to compound at 10%. And I don't think that food delivery is the real opportunity here for Grab. We'll get into that here. Skipping over a bunch of stuff here, you can read it on your own leisure, but I want to get to the meat and potatoes of things here, because in essence, food deliveries are low margin, high volume. So that's really the game you're playing with food delivery here. You take a small, cut of each order. It's all about volume to actually start to generate revenue, but the take rates are, the margins rather are quite low. Now, how do they elevate that? And I think the blueprint can be found by looking over to China. You remember how I talked about, WeChat? Well, there's another service called Meituan, where basically 85%, across Chinese major cities, 85% penetration rate for this service. And what they do is that beyond just, food and groceries, basically any item imaginable can be delivered near instantly. And we're talking, electronics, daily utilities, clothes, anything imaginable. And what's so special about it is that it only takes about 30 minutes to an hour across, around the clock. So in the middle of the night, if you're like, my camera battery just died, I need a new one. 30 minutes later, someone's at your door in the middle of the night with a new camera battery. I mean, basically anything imaginable. Like, let's say that you're outside at a nightclub and someone spilled something on your shirt. You can order a new shirt and have it delivered, near instantly. Like, this is the kind of service that Meituan can offer only because it has such massive scale and such massive penetration. Because when you have such a high, penetration, all of the merchants, across each operating region, they want to be part of the platform. They want to have their products, on the platform. And when you have so many drivers with scale, you can really enable that, 30 to 60 minute, delivery window. And that's why so many users are using it, because the convenience is, unimaginable in the West. Like, I can't even imagine what it's like in Japan, that whatever I want to have, I can have within 30 to 60 minutes. And this, unlike, mere food delivery, fast food delivery, is actually quite high margin. Now, Southeast Asia as a market is still quite underdeveloped. They are a bit away from this, but this is really what the blueprint looks like for the segment. And that will really elevate margins a lot. And, in Southeast Asia, even, having food delivered is seen something like a premium, where it's not, because the countries themselves, they're not that rich yet. They're expected to, grow GDP very, very fast. But where they are today, they're still, relatively, by Western standards, they're still quite poor countries. So, having food delivery and stuff like that is still, seen as something as a premium. And in China, the markups over dining in are negligible, compared to having it delivered. But, in the West, food delivery is still seen as something like a premium. Now, Grab does address that by having different options where, for example, you can wait slightly longer and lower the cost. And the primary goal of that is just, increase the frequency of orders, increase the volume rather than, the average order volume. Because as you increase the user base, you have more people use the product, you can then cross-sell them and expand the ecosystem simultaneously, with the end goal being something like Meituan, where, you can have anything within 30 minutes of ordering it, no matter where you are, no matter what time of the day. So that's really the opportunity that I see here. And, the e-commerce market in Southeast Asia, it's actually not that small. It's expected to compound, a lot faster than the food delivery market, the whole e-commerce market. And of the total 182 billion in e-commerce GMV in 2025, only 13% was, grocery. And then you can count, food as a subset of that. But, the rest, the other 87% are non-grocery. And, it is only natural that Grab will start to go after that part of the, that slice of the pie. But that's also, a bloodbath on its own, because there's a lot of competition. You have Shopee, TikTok Shop, and all of these different, marketplaces that are similar, or Amazon-like in the region. But Meituan is not a marketplace like that. And they have a completely different DNA, where it's more about, a point-to-point service with instant delivery, rather than, offering a marketplace of all of these different products, where people, shop around that. So there's a lot of competition in the space, but I think that the end game for Grab is something like Meituan. Rather than, brick and mortar, where you have a warehouse and people order from the warehouse and stuff like that. That's not what I believe Grab will be doing. There's still, and there's already a lot of people doing that, warehouse approach. I just think that this will be like a delivery platform, more or less, if I, can hope and wish for the segment. But there's a lot of high margin potential in the segment is the key takeaway here. And then we have financial services. In general, similar to, something like Japan, where I'm currently, Southeast Asia is still relatively cash heavy, something like 2 out of 3 people, are, underserved and underbanked in the region as a whole. It is still, a relatively new concept, to be paying cashless and stuff like that. No, of course, for Grab, introducing financial services was more or less, a need to, make safer transactions. You can pay cashless. You don't have to carry around cash and stuff like that. So having, a way to pay for different Grab services was natural, and that's, how it began. But it's developed into, full digital banking licenses, insurance, lending to merchants, lending to users, and stuff like that. And if you look here, for the Southeast Asian market, the black bar here is the 2019 market share of financial application downloads per region. So here we have something like the US, quite a high share. But then we look at Southeast Asia, relatively low here, but the fastest growing one. So it went from 6 to 12% in 2025. So it basically doubled. Now only Mexico also managed to grow that market share by 6%. But 12% of all application downloads in 2025 were financial applications. So the segment itself is growing quite fast. And you can really see that while digital payments as a whole is only expected to compound at 12% in the region, if you look at something like digital wealth assets under management, it's expected to compound at 37%. That is massively fast. Digital lending loan book balances expected to grow at 20%. And out of those, small to medium-sized enterprises are expected to grow their digital loan book balances by 25%. Consumers at 19%, so that, given the volume, it evens out to 20% compounded for both of those segments. But these are, very, very fast growth rates. And the financial services segment, it is still, negatively, it's still negative on an adjusted EBITDA margin, but it's expected to be one of the biggest profit drivers for Grab. And, financial services are, famously high margin. So yeah, expected to compound, in aggregate at 20% for the digital loan book. And that's really the one that applies the most to Grab, given what they're offering right now. Because Grab are just now starting to expand their loan book. They grew it by 120%. And Collective still a really attractive yield on that, loan book. But you might be alarmed, because when you look at this loan portfolio of Grab here, you can see that more or less each passing quarter, the yield, what part of the loan portfolio, is effective, financial services revenue. So how much of that actually translates to revenue? It is going down. And then you wonder, well, why is that? Is that a red flag? But that's, just the nature of, maturing the balance sheet, because the loan book is growing so fast, but it actually, new loans don't generate a full year of interest and fees in the first 12 months, So disbursements only grew 53%, and the total portfolio grew 120% year over year. So that's why you see, the yield going down, is simply because the loan portfolio is growing so fast, and they simply haven't had time to, collect the fees and interest on that loan book. So it will stabilize, but now as it's, in its hyper growth phase, this might look alarming at first. And, they are also moving away from, high rate microloan towards, larger loan portfolio, having cheaper customer deposits, using their consumer data in the ecosystem, because, over time they learn how you spend your money, which allows them to have, good credit score models in-house, can reduce the risk on, underwriting loans. And that also means that they don't have to provision so much for credit losses and stuff like that. So this will, over time, with scale, just like any of the other segments, it will become more profitable with scale, and it is expected to grow very, very fast. And if we look at the other segments, beyond financial services, one of the most interesting one is actually the ad platform. Now, Grab is looking, to embed AI across their whole ecosystem. And again, that really benefits everyone and makes the whole ecosystem more attractive. But what I want to talk about in this video in particular is how it helps with the advertising business. So we have the chart here. I had to stitch this together because they don't really report it in a table. They give you, bits and pieces, but if you can do some simple math, you can, calculate the active advertisers. So 228K active advertisers in Q4 of 2025. If we go back to, Q1 of 2023, they were only at 82,000. So it is growing fast. But what's interesting here is not only how fast this is growing, but how it is differentiated and what the unit economics are. So we only have 2 snapshots given the, data for, the advertisement business. In Q1 of 2024, adjusted EBITDA margins for advertising was 60% with a take rate of 74%. So of the, GMV, 74% of that translated into revenue from the ads business. And it is currently hidden, inside the delivery segment. So you can't really, break it out. You have to, piece together what they're, reporting briefly in text. 74% take rate, 60% adjusted EBITDA margins. In the same year, so not Q1 2024, but Q4 2024, the take rate had increased to 98%. Basically, all of the volume translated directly to revenue, which is of course super impressive. And this will be a major growth driver for Grab. And the way it is differentiated is that Grab, they have a lot micro, small, and medium-sized businesses. And in some cases, merchants run their whole business inside of the Grab ecosystem. They might only have a smartphone. They do the accounting, they are the bookkeeper, they are the marketer, they're also the cook on the ground. And these are very, very price sensitive. When you're so little in scale, you're not looking to like, okay, gonna play some ads on face through Meta or through Google Ads. You're really price sensitive, and you might not really understand how to best spend money on advertising. So ease of use, very important here. And Grab, they basically ask you 3 questions, and then they set up an ads campaign for you. And what's so interesting is that Grab ads are being served to Grab users. So they know what you're trying to achieve. They know the spending habits of Grab users on their platform, and they can track exactly how many of the served ads basically convert. So the merchants, they build, launch, track, and manage their whole ad campaigns within the Grab ecosystem. And you can't really get that like when you advertise, something like on Meta, or Google Ads. It's not all within the same ecosystem. You can't really have the same kind of tracking. You can't have the same targeting, and it's definitely not as simple and as efficient to create, a very, very attractive ad campaign as it is through Grab. So yeah, using the user data, Grab can efficiently target suitable users and not waste the paid for visibility, purchase history, location, other user behaviors like, where they are, at what time of day, they do different things. And, the user wins because he's only being served ads that actually relate to what he's interested in, and the merchants win by having their ads served to people that are actually interested in it. So when the budget is near zero, conversion rates become very important, and seeing actual returns on advertisement spending through the integrated tracking gives them the confidence to keep spending on ads. So ads growing very, very fast. Yes, but there is a lot of competition in Southeast Asia. As I mentioned, even though Grab has emerged as a victor, by overall market share in Southeast Asia, that does not mean that it is, completely dominant in every single country. And you can see that in two lights. First, it means that there's still a lot of market share to be attained in a rapidly growing market, as we've been discussing. And second, there may be competitors that will push margins down for everyone that is competing. And for example, in the largest market for Grab is Indonesia. It has the most people. It is growing, fast and very, underpenetrated. There, it has about a third of all the C6 population, which is the 6 major Southeast Asian countries. They have actually a close competitor in Gojek, and in Vietnam, which is the second largest market. They are roughly tied in market share with Shopee Food if you look at the deliveries. In Thailand, a local company called Lineman is a close second, and so forth. So basically, across every market, there are some local competitors, whereas Grab might be the largest in each main geography, and in Southeast Asia as a whole, there's still a lot of local competition, and that of course does push margins down slightly. However, most of these are losing a lot of money to operate. Grab used to be in that situation, but they're now actually moving away from that because their ecosystem is so big. It is so attractive to users to just use Grab, gain Grab points, spend them, be loyal inside the Grab platform, that they can actually start, to not participate as much in the incentive war. So if we look here across the 3 major ones, if you look at the delivery GMV and then the incentives as a percentage of the GMV, it has gone down, since 2021, where it was something like 16% to stabilize around 12%. And in the mobility, we're stabilizing at somewhere around 8%. And if we don't have reported figures for, going back, 10 years. So we don't know like how the bloodiest of the bloody times were. But they're growing, GMV very fast, and they're managing to do it while not overspending on incentives. So when you see a graph like this mobility one that is just, going up and into the right, but you're managing to keep incentives flat, that is generally very, very positive for your business. Now, of course, it's better if you could decrease in incentives, and I believe that they will be able to over time. But, those are 2 different dynamics that are very, very attractive for your business. And if you look at, loans disbursed, you can see that they're paying a lot less now. Basically, 25% of what they used to pay 2 years later. So beginning of 2023, it was about 2%. And now it's about 0.5%. So they managed to decrease that a lot while still growing, the loan disbursements by a lot. So Grab really has the benefit now of being at such a grand scale that they can, wind down their incentive programs, focus more on margins while still competing, while still gaining market share, while still growing. And a lot of these local players, they can't really afford to do that because they don't have the same scale, they don't have the same ecosystem, they don't have the same coverage, they don't have the same utilization. So really, the only thing they can do is lower their prices compared to Grab to try and, get some of Grab's market. But they're losing a lot of money doing so, while Grab is now actually starting to generate money and doesn't have to participate to the same degree. So that's really how they're being differentiated. So yeah, it is really impressive when you consider, how many different geographies that Grab operates in against people who maybe only focus on one single product. I mean, Grab is expanding massively now. That turned out to be a big win for Grab because as you expand services and products, you give the user more incentives to use you over someone else. And we just recently got news that they just acquired, Food Panda in Taiwan. So the operations that Food Panda had in Taiwan, expected to close in the second half of 2026. But Food Panda was already struggling, and this kind of consolidation is what we will keep seeing, I believe, in Southeast Asia. They previously exited Thailand in 2025. They are falling behind in the regional competition. You'll see more and more companies throw in the towel. Now, Food Panda actually is positive on an adjusted EBITDA. They are, profitable. And there's only one other major competitor in Taiwan, and that is Uber. Uber, which, acquired a 30% stake in Grab, when Grab took them over in Southeast Asia. So you can imagine that they're not going to be running each other into the ground, in terms of margin wars. Let's see. But in terms of competition, there is another major acquisition target that's been, the rumors have been circulating for quite a while, and that is Goto, which owns Gojek. As I mentioned, is a close second in Indonesia, the largest market. And if they were to acquire Gojek or Goto rather, that would imply a near monopoly in Indonesia in both deliveries and mobility. And Indonesia, as we talked about, is the biggest market by far. So eliminating the biggest competitor, having a near monopoly, would mean a lot of scale added to the business first and foremost. And we talked about how the flywheel works and how it, accelerates future of the business, with more and more ways to earn money from your users, from your merchants and so forth. So scale, but also they can actually stop the incentive wars and actually start to scale that margin upwards as well. Now, there's a lot of, monopoly concerns over this. Indonesia already had, large issues domestically regarding, driver pay, stuff like that. The government is getting involved. There's a lot of things standing in the way of this, merger and acquisition. But, Gojek, the CEO stepped down. They promoted the CFO, recently. This was, seen as something like, okay, they're doing this, to start, negotiating the M&A deal and stuff like that. So there's a lot of drama, as I mentioned. The government stepped in to draft new online moto taxi regulations, because minimum earnings are becoming a problem in this industry. They want to introduce commission caps. They want to see how, delivering food actually affects the worker status. So there's a lot of things going on there. Now, if this deal does not go through, Grab will still be fine in Indonesia. They don't require this deal to go through to be successful. They are mature enough and they reach scale enough where they can compete, very attractively against something like Goto in the region. But if the deal was to go through, that would be a massive win in the largest Southeast Asian market. So that's something to keep track of. Now, I wanted to make this video 20 minutes. We're already 43 minutes in. Should I talk quickly about the valuation? Well, it's been a while since you guys saw any of my valuation models. So I'm putting it on the screen here. It might look like, oh my God, there's so many lines. It's so complex. No, it's actually quite simple, There are many lines because there are 3 lines of business with different characteristics, different margin profiles, different growth rates. So I just break it down to deliveries, mobility, and financial services. Same thing on how profitable those segments are, but it's a simple model. And I go through in the PDF here that you can download for free, as I mentioned. I go through why the numbers are what they are. I compare it to Uber, what the benefits for Grab is, compared to Uber, because there are structural differences. For example, motorcycles require dramatically lower fuel. A lot of the mobility, the ride-hailing segment is a lot of two-wheelers in Southeast Asia, whereas that's not the case for Uber. Maintenance costs are lower, so the profitability for Grab can be a lot higher than what Uber has, because Uber has a lot higher variable costs. But yeah, you can read that yourself. I'm not going to go through it, but yeah, for the first time in a long time on the channel, we have a look at the valuation model. So go grab the PDF report over on typefcapital.com. Available completely for free. I'll put a link into the description, and thank you so much for listening, and let me know what you think about Grab. I believe that is, the opportunities ahead of Grab are, quite big, and they're just now, becoming profitable, just now reaching scale where they can start to leverage that scale, to accelerate growth even faster, while doing it, more profitably than before. So yeah, I think this company is a bit slept on. We'll see how long that lasts. I believe that it is worth about double from where it's trading today. We'll see. I might do a follow-up on this one. I might track it, on a quarterly basis. But yeah, really interesting company. Go grab the PDF report, and thank you so much for watching, and catch you guys in the next one. Bye-bye.